Hi, everyone. In this lecture, we're going to speak about the Sarbanes Oxley Act and internal controls. Sarbanes Oxley, also known as SOX. So again, these are the skills that we're going to cover in this lecture. So we're going to begin with publicly traded companies. As you know, we've been working with Netflix throughout this course, and Netflix is a publicly traded company. And all public companies must file a 10K report with the Securities and Exchange Commission, the SEC. And they must also adhere to GAAP rules. And all companies must also comply with the Sarbanes-Oxley Act of 2002. What this means in summary is that all publicly traded companies have to file their financials with the Securities and Exchange Commission, and they must be prepared according to GAAP rules, which we've learned in previous lectures. And when they are preparing their financials, they must comply with the Sarbanes-Oxley of 2002. So what exactly is that? So it was a law that Congress passed in July of 2002 in an effort to protect investors from fraudulent financial reporting by corporations. This was a result of a financial scandal that involved the Enron Corporation. If you've not heard of that, we'll be speaking about that financial scandal in a bit. So what this act did is it created strict new rules for accountants and auditors and corporate officers, and imposed very stringent record-keeping requirements. And what it also did was it placed responsibility on corporate officers for whatever has been filed with the SEC. So in the past, the corporate officer can say, well, my accountant prepared that for me, or my auditing office prepared that for me, and they would not face any responsibility for any wrongdoing. And the Sarbanes-Oxley Act of 2002 changed that. Some of the rules that affected the record keeping was the destruction and falsification of records became violations. They made stringent time records of how long you would have to keep some information on record: 5 years for invoices, 7 years for tax returns, and payroll and bank statements have to be kept forever. And all business records, including electronic communication, has to be stored according to the Sarbanes-Oxley Act of 2002. And there were no criminal penalties, stricter criminal penalties for violating this law that could reach fines up to $5 million and 20 years in prison. So what happens if these procedures are not followed? Well, you get yourself into some financial fraud scandals. And this is what I call the fraud triangle. And fraud typically occurs when there is an opportunity, when there's pressure, and when it's rationalized in someone's head to think that the wrongdoing that they're doing is actually right because they've made the rationalization in their head. So for opportunity, if a company has poor internal controls or poor corporate governance, where there are not many rules and procedures set in place, there's an opportunity for fraud to take place. And regarding pressure, well, leadership can sometimes, give some unrealistic goals and saying, we have to meet these numbers or else you're going to be fired. And from that pressure, someone can feel that they have to do this wrongdoing. And the rationalization is, no matter what, we have to maintain profitability. So whatever the numbers turn out to be, if we have to make any changes to maintain that profitability, we have to do it. So these are some of the fraud scandals that are noteworthy that have happened since the 1990s through 2016. And we're going to get into some of these in a little more detail. So WorldCom, telecom company, they treated the rental of the cell phone towers as an asset when it should have been treated as an expense. So WorldCom did not own these rental towers, right? these towers, these cell phone towers, they rented them. So that's an expense. But they were trying to tell the SEC, no, we own them, so it's an asset, which turned out to be false. And it inflated their revenues by $11 billion. And this was uncovered by an internal auditing department. And the CEO was sentenced to 25 years. And WorldCom is no longer in business. So the Enron scandal was back in the 2000s, which was a result of the Sarbanes Oxley Act. So they didn't record any debt on their balance sheet. And what they did is they set up these little side companies and pushed the debt over to these side companies so that the debt didn't show up on Enron's financials. So if you were doing some financial analysis on Enron, you would say, wow, they're doing pretty well because they really don't have much debt. One of the other things that they did is they falsely increased the depreciation time length for their property, plant, and equipment on the balance sheet. So as we had stated, if you purchase a vehicle and according to, the IRS, the lifespan of a vehicle is 5 years and you record that over 10 years, well, you're falsifying documents. They used mark-to-market strategies, which is recording revenues based on projections, which is a big no-no. So for example, they signed a deal with Blockbuster Video that was worth $100 million, but this deal didn't go through and Enron kept it on their books. This was uncovered by a whistleblower, and their auditor, which is one of the big 5 accounting firms, Arthur Andersen, was paid off to go along with these falsified records. And if you're interested in learning more about the Enron scandal, there is a movie out called The Smartest Guys in the Room. If you look around for it, I'm sure that you can find it. It's a really good movie. So more recently, there's Theranos, and this was introduced by Elizabeth Holmes. She's been in the news recently, and she was creating a new blood testing technology where with the prick of a finger, several blood tests would be able to be run on an individual. And she secured, about $700 million from outside investors. And so as she's going along with the company, she needed to perform demonstrations, and she did, but she was using someone else's technology. And then in 2006, the CFO was fired for questioning Elizabeth Holmes' reliability and honesty. Theranos made deals with Walgreens and Safeway, and Walgreens and Safeway kept saying, okay, where's this machine? We want to have it in our store. But Theranos could not produce anything because there was no technology. So what happened with this? Well, Elizabeth Holmes is currently going on trial, so this remains to be seen. And then there's the Bernie Madoff Ponzi scheme, where he duped investors up to $20 billion. And some claim that one of the reasons Madoff was able to get away with this is because he was the chairman of NASDAQ, and he was a highly trusted individual. And he knew a lot about, trading, and he knew a lot about returns and dividends. So he said, invest with me and I'll give you 10 to 12% returns annually at a guarantee. And because of his experience with NASDAQ, he knew that 5% would be too low to lure people in and 15% would be too high. So he went right in the middle. Unfortunately, Bernie Madoff, took your money, said he was going to make these investments for you, but there were no investments ever made. He created fake financial reports that were distributed to investors, and it all came crumbling down. Another great film from HBO, The Wizard of Lies, goes into more depth about the Bernie Madoff Ponzi scheme. And then there's Jordan Belfort, the Wolf of Wall Street, and he used penny stocks to lure in investors, right? So this is, it's a very persuasive tactic in order to get investors to buy in, right? And it's called the pump and dump scheme. So as your stockbroker, if you're fortunate enough to have one, calls you and tells you, hey, I've got the next best thing. You have to invest in this, and they're very, very persuasive. And you invest, right? You say, okay, great. But what they fail to tell you is that they also have a position in the same stock. So as you're investing, right, it drives up the stock of the price, it drives it up and drives it up. And then your stockbroker cashes out, and then the stock price dips and you've lost your investment. Okay, so this is a way of, getting you to buy in. I know about this deal as well. I'm going to buy in. I'm going to inflate the price. Once it's so inflated, I'm going to take the money out and you lose all of your money. So next we're going to talk about internal controls. And so internal controls are ways of preventing and protecting information inside of your company. And the first thing we're going to talk about are preventive internal controls. And one preventive control is the separation or segregation of duties. And this is having different people in different roles, right? So as an example, in your accounting department, if you have a person who is setting up vendors and that same person is paying vendors, well, that's not such a good thing, because that person who's setting up the vendors can set up fake vendors, and when it comes time to paying them, they also have the authority to pay those fake vendors, which can be themselves. Another preventive control is pre-approval on invoices at a certain amount. So some companies may institute a policy where if an invoice for $50,000 come in, there has to be an approval, whether you knew that this invoice was coming or not, but it has to go to a higher authority, just to make sure that there are another set of eyes looking over, what's being spent. And also there are locks on inventory. For example, Starbucks warehouses their free cup of coffee coupons, right? To keep that, it's a preventive control so that employees don't go in and start handing these out to, all of their family and friends. So those are some of the preventive controls that you can institute in a company to try and avoid fraudulent behavior. Then there are detective internal controls, and these are controls that unfortunately identify issues after the fact, right? So you can go through reconciliation efforts, and here it's got 500 computers, but after an audit there are 450 computers. This can be the reconciliation of supplies that were purchased. You have records of all of the supplies that you've purchased, and then at the end of the month, you see that you've ordered 50 toner cartridges and there's only one left, and that seems suspicious for your department. Audits, it's just making sure that defined processes and procedures are being followed. When you're working at a company, you'll be given a computer, and there's usually a tag on that computer to keep it, in inventory for the company. And then, where are these tags kept, and what happens if the count is off, and how often is the audit done, right? So these are all things that companies can do to try and get things back in line. And there can also be surprise counts on inventory. Hey, today's Tuesday and we're going to check the number of pens that we have in the supply cabinet. Then there are Excel internal controls. So when people are preparing financial statements, one of the first places that they start is typically with Excel. They do move on to more sophisticated software, but a lot of the data begins with Excel, and there are many things that you can do with Excel to try and protect the data. The first thing is password protect files. You can lock cells, especially those that contain formulas. So let's say I have a file that I've created and I need you to fill in 2 cells. I'm going to lock everything else so that you cannot manipulate that data. Data validation, it decreases the amount of data input. And a good example of this is if you're keeping a list of all the employees and you have offices throughout the United States, rather than typing in New York or Washington, where some people may put NY or NYC or capital W, lowercase a, but you can create data validation so that the state remains the same for every single entry. Then there's the input and output of data, which is color coding so that users of your Excel spreadsheet are aware of where they need to input data. You may color something in yellow, which I've done in several of the assignments already. So yellow is an input cell, and I may highlight blue as an output of data showing you this is where the results are going to appear. You can also create an information tab. So this is creating another worksheet within your Excel file that debriefs anyone that may use the file with the file name, the version, the date, who has access to it, etc. And Excel also has a run error check function. So in summary, we've learned about the SOX Act, which mainly holds corporate officers responsible for the financial reports that are submitted to the SEC, and it is to protect the public and stakeholders from fraudulent activity. And the accounting is the reporting of transactions. Well, we've learned that already. So for the internal control side of things, you have 3 types of controls: preventive controls, which is segregation of duties; detective controls, audits; and Excel controls, including password protection, data validation, and locked cells. So I hope that you enjoyed this lecture, and I'll see you again soon.